on stocks, bonds, currencies, and commodities. We would typically try to see how do I compute the forward price for those kind of entities, derivatives on those kind of underlying securities, and even for the futures, what kind of differences exist between the forwards and the future prices, especially for these kind of securities, right? So to get into it, first of all, I need to have an understanding on whether the underlying asset is an investment asset or a consumption asset. What is the difference between these two? When I'm talking about an investment asset, that particular asset generally is held by good number of investors, primarily from an investment perspective. Some people may still use it for a consumption perspective, but majority of the participants, they invest in it. They purchase that from a perspective of investment rather than from a perspective of consumption. So, though gold and silver can very well be used for some kind of consumption purposes, they are used as raw materials for producing something, but majority of the people make their investment in gold primarily from an investment dimension, not from a consumption purpose. So those kind of assets are all categorized as investment assets, whereas any kind of assets which are used primarily from a consumption perspective, probably when I'm investing something in oil or copper, the intention is copper is used as a raw material for preparing manufacturing lots and lots of products. So that is more of a consumption kind of an asset. Oil can be used for either household consumption or industrial consumptions. So it's more from a consumption perspective, not from an investment perspective. Whereas when I talk about, let's say, stocks or bonds or any financial investments, financial instruments, I'm trying to invest in them primarily from the perspective of investment. But if I'm looking at commodities, some kind of commodities come under the consumption commodities, some other kind of commodities come under the investment commodities. We need to have some kind of an understanding or a clear-cut differentiation between these two groups of assets because the valuations differ between these two groups of assets. So we are typically now looking at the determination of the price for each of these. Initially, we will focus on investment assets and then slowly move on to the consumption assets as well. And what we could typically see is the concept of arbitrage, a risk-less profit. That particular concept can very comfortably be used in case of investment assets to arrive at their forward or futures prices. But the same cannot be applied in case of consumption assets because we are not talking of purely an investment. It could be consumed from now to a month later. So a pure arbitrage concept cannot be used for the pricing for consumption assets, whereas when it comes to investment assets, I can comfortably use the arbitrage concept. And one more important point that we need to understand in this context before we start getting into the pricing processes is we use the word shorting, or probably sometimes we call it short selling. What this actually means as a terminology is selling something without owning it. Now, how can I do that? Selling without owning. I can borrow from the broker. I can borrow from the broker, which means broker is going to take those assets from someone else, from some other client, and lend it to me. And from that lending, I'm going to sell it off. So I'm going to get the proceeds of that. And at a future date, probably I'm going to buy back those securities from the market and return them back to the broker. And if at all I am able to make a profit in it, that profit belongs to me. Otherwise, the loss belongs to me. So that is what is a typical mechanism of short selling. I am borrowing something from the broker, and based on whatever I have borrowed, I am selling it in the market, and I am taking the proceeds then and there itself. But in some cases, what could very well happen is the broker may not be able to borrow any more securities. The broker may be having a restriction in terms of taking from different clients. He is not able to get the securities from the different client, or probably the client is very much determined to sell off his securities, so he is demanding his securities back. Then I cannot wait until an opportunity comes back for me to buy back at a favorable price. I may have to close this short position immediately so as to give back the securities back to the broker, who may have to replenish his clients, replenish them back to his client. So in that case, I am forced to close out my selling position, and that is what we typically call as short squeezing, because my short position is getting squeezed. I am forced to close out the short position even if I am not ready to do so. And as a part of this entire short selling process, whatever the proceeds that come, so this is generally done under the intention that the security prices are going to fall in future. Right, if the security prices are expected to fall in future, now I don't have the security, so I have borrowed them, sold them in the market. So currently the price is much higher, so I am going to receive a higher amount. And because the security price is expected to fall in future, probably after a certain point in time when the securities price has fallen, I'm going to buy back those securities and refund them back to my broker. So I might have bought them at a lesser price, and because of that buying out at a lesser price, I am able to make a profit in the process, and that profit is completely belongs to the person who has got into the shorting process, which is me. But in this process, whatever the dividends that are declared, or whatever the interest that comes, if the shorting has happened not on shares but let's say on bonds, whatever the dividend has come out, whatever the interest that is going to come between this shorting period and buyback period, whatever the company has declared the dividends or the interest, this person who has shorted, he has to refund it back to the broker, who would be giving it back to the client. So the client would still be the owner, because this is just a borrowing here, whereas this party is still the owner. So the dividends and all are belong to this particular client who has lent the securities. So any dividends and all that are received during the period, they need to be refunded back to the client. And in this entire process, the investor has to maintain a margin account with the broker. Just like we talked about the margin account in case of futures contract, here also we are talking about in any kind of a short selling process, the investor is required to maintain a margin account So this margin account can be filled with cash or any other marketable securities which can be converted into cash quite easily. And see this margin is like a protection in case the securities price is not falling but it is rising, and then the investor who has shorted the security is actually losing. To make sure that this person who has shorted is not defaulting or is not refunding the securities back, this margin will be acting as a cushion in that case. So this is again, there is an initial margin, the initial deposit that needs to be made, and probably if at all required, an additional margin also can be requested by the broker. And the main intention is, in case the person is defaulting because the security price is going up not falling, to protect the client against the loss of the securities, this margin is really helping out. And one more advantage is, even though a margin is deposited, generally interest is paid on the margin balance. So that means whatever the margin that has deposited, even that is carrying some additional interest also. And whatever the proceeds that come, they all completely belong to the investor only, except for the dividends and the interest that come, which belong to the original client. Whatever the sales proceeds that come, whatever the additional profit that comes, that entire thing belongs to the